Welcome to ForexTV.com. Today's Monday, February 9th. I'm Tim Kelly with your New York Forex Market Buzz. On the eve of the U.S. Senate vote on the Obama stimulus package, markets have been idling along for several hours. Let's now take a look at the latest headlines from the CEP news desk. Stocks have trimmed losses as markets await stimulus and treasury plans. U.S. dollar is the worst performing major currency. Oil rises, gold falls. Treasury fall to fresh two-month lows, and markets seem to be in a holding pattern ahead of key announcements. All eyes are on the U.S. government on Monday as officials prepare to unveil a pair of separate measures designed to jumpstart the economy. The U.S. Treasury was expected to announce a plan on Monday that included an aggregator bank and other provisions to stimulate lending and prevent foreclosures. But the plan was pushed back until Tuesday as officials hammer out the details. Another reason given for the delay was to keep the focus on a stimulus package being debated by U.S. lawmakers. The vote was initially expected Friday, but wrangling on some of the provisions pushed it back until at least Tuesday, which is tomorrow. The delays initially soured market sentiment this morning, and the main indexes were down about 1%, but a rebound later materialized. Today we're joined by Greg Michalowski, Vice President of Trading and Liquidity at FXDD. Greg, welcome to the program.
Happy to be here. Thanks, Tim.
Well, we've got a bit of news, but a bit of no news right now. So why don't we've got a blank slate to work with here, Greg. So why don't you take us through some of the concepts you've been working with on the technical side. I know we're at some key levels as you discussed for Euro and for Aussie, and it seems like risk is coming back into play here. You want to tell us a little bit about what's going on?
Sure, Tim. I'd be happy to. First of all, the Aussie dollar, I'm interested in that chart at the moment from a technical basis, and there's some fundamentals behind it as well. But and the fundamentals would be the Baltic Dry Index, which if you pay attention, the markets has been going up at a steady pace here over the last 14 days. In fact, it's been up, and what this index measures is the shipping costs of non-liquid commodities around the globe, and so it'll track like iron ore or other industrial commodities that may come out of Australia, for instance, and that is what we're seeing. We're seeing the Baltic Index go up over the last 14 days, and the thought is, or what the word is that they are shipping more iron ore to places like China, who has depleted their inventory of this commodity as they continue to expand, albeit at a slower pace, but they do continue to expand. And this is helping the Australian dollar in the process. From a key technical level, we are right at the 100-day moving average, or testing that level. That level comes in at the 69.42 level, and we've gone up there on a couple of occasions today on an intraday basis and sort of kissed off that level.
Greg, let me interrupt you there. Sure. 68.42 or 69.42?
I'm sorry, 69.42.
68.42.
Yeah, you are no, you're right. I'm looking at one of my charts with have the wrong.
No worries.
Number.
Yep, but continue.
No, it is 68.42, and I apologize for the chart. I think that I sent has the wrong big figure on there. So it is a 68.42 level. Thanks for correcting me, Tim. But that level, or the 100-day moving average, has not been breached since July of 2008. We did go and test it earlier in January. On two separate days, we traded above it, but we're not able to close above that level, above the 100-day moving average. So right now, if the market is able to squeeze through on the close today, or perhaps over the next couple days, if it can continue to move higher, I think we're going to see further short covering in the Aussie dollar, and it may just be on the back of this increase in the Baltic Index over the shorter term. To put things though in perspective, however, the good news is that it's been up for 14 days and moved up from a level of 663 in December to a level of 1642 today. The bad news, however, is since June of 2008, the index has moved down from well over 11,000 to the current level of 1648. So although there's good news in the short term, the bad news from last year is certainly still there in the market. Nevertheless, the Aussie dollar has been sold off quite dramatically from the highs over the last, since July really of last year, and as a result, there is this opportunity for short covering rallies, and this would be I think this would be a signal to the market that the Aussie dollar can continue to go higher if we're able to close through this level. You mentioned the euro as well. From my technical perspective for the euro, it's been moving up and down, sort of in a non-trending, well, not sort of, but in a non-trending pattern. The chart that I provided you here is a 4-hour chart going back to January 9th. And as you can see, the 130.70 one area has been a level of reflection or deflection of the price action on 6 different occasions, and probably more actually. The price has gone down, tested a level, bounced, gone down, tested, bounced, gone through it, come up, bounced below it, and this happened at least 6 different times. As you can see, that the price doesn't really like to trade around that, trade for any considerable time period around that price level, which suggests to me that if we're able to move above this level today, since we're coming from below, that the market would probably tend to continue to move higher from a technical basis, and this would be a positive for the euro, and may see the euro go up and test that green line in the chart, which represents the 200 bar moving average on the 4-hour chart here. Right. But overall, the euro is still in a non-trending pattern. But you look for, when you have a non-trending market, I always tend to look for it to change to trend, to a trend mode, because that is where traders make the most money, is when the markets are trending, not when they're not trending. Right,
Greg. The 2 levels that you mentioned, which are for Aussie and for Euro, are just below the 61% Fibonacci retracement from early January as well. Right now, we're in a holding pattern. Do you see this this holding pattern continuing till tomorrow for the short-term trader?
Well, certainly, Tim. As you mentioned earlier, we have a lot of stuff coming out of Washington, and I think overall, in my opinion, it's not really shaping up to all that positive. We saw on Friday the non-farm payroll lose 600,000 jobs, 1.8 million in the last 3 months, and the word toxic paper that they talk about and trying to rid the banks of this. This isn't anything new. We talked about this in September originally when Paulson proposed his plan, and nothing was ever made of it. Now the word toxic is becoming a little bit more toxic, in my opinion, as you add these job losses, because banks see, and banks and investors see, including the government, I guess, see the downside probably increasing as far as the toxic paper goes, just as a result of more foreclosures as more people lose their jobs. So this is the idea that they're going to be able to sell it to private investors and figure out some sort of price that would make the banks happy and the private investors happy. Maybe more pie in the sky now than it was in September. Right. And so this may, I don't know how it's all going to play out, but I'm not all that positive about it right now. Of course, you hope for the best, but I'm not sure I see a silver lining at the end of this in this cloud here. Okay,
Greg. Well, we'll leave it right there. I want to thank you for joining us today. I'm also going to ask you to come back, and we'll see if we get over those levels.
Absolutely.
This has been your New York Forex Market Buzz with Greg Michalowski at FXDD. I'm Tim Kelly. Join us later this afternoon for PM Exchange right here on ForexTV.com.